to the cloud.
Well, wonderful. Thank you all for coming today. Again, I'm Jessica Viticanicius, the director of the Washington Women's Business Center. And today we're going to take a tour of the basic financial statements and how to understand them and how to use them in your business ventures. And this is also helpful information if you're doing a nonprofit, because you'll still have to, be mindful of the money that comes and goes within your nonprofit, as well as with your business. So you'll get a chance to ask some questions. Feel free to put questions in the chat, and I'll stop periodically to check on them. Excuse me, it sounds like my voice is trying to go out already. Come on, hold on. And then there'll be some opportunities for you to break out with each other and to work together to understand these. I'm hoping to have some good hands-on time with the financial projections worksheet, so you get the experience of how the numbers work together and how they move and how they fluctuate according to the information you put in, so that you can get a sense of what cash flow is going to look like, how a profit and loss statement works, and how to understand the basics of a balance sheet. So without any further ado, we'll jump into it. I'll share my screen and we'll get on this. And there'll be a couple little videos, and there'll be a very small quiz at the end that we'll all share the answers to together. So it's a nice and easy one, don't worry. Let's see if I can get all of your faces here where I can see you. There we go. That's better. All right. And is my slideshow going? So, understanding and using financial statements. All right, give my slideshow a second to get going. There we go. Understanding and using financial statements. We're going to talk for a minute about the importance of financial literacy. We're going to explore the two types of accounting methods. We'll talk about the financial statements in greater detail. We'll explore making a financial projection, and we'll talk about break-even analysis and what that means. So the basic thing you want to know when you're thinking about financial literacy is it's important for you to have that understanding of these financial statements and how they work, because the basic financial literacy is tremendously helpful to you as you go forward in your business and your other endeavors related to business, because you're going to get reports from your bookkeepers, your accountants, and having that knowledge of how those numbers work and what those numbers mean is very empowering to you as a business person, and it enables you to make good decisions and to understand how the money is moving in and out of your business. Money is like the breath of your business. So you inhale and you exhale, and the parts that you are able to secure for yourself come out of that flow. But a lot of it is about that flow of the money coming in and coming out. And we're going to let this nice lady tell us for a few minutes about the basics for business finances.
If you want to build a sustainable business, one of the most important things that you can do is learn how to establish a solid financial foundation. I know that.
Let me set that to normal speed. Okay, it is normal speed. I listen to them at double speed a lot, so I just wanted to make sure it was.
For a lot of people, numbers just aren't their favorite. Maybe you've never been a math person, or maybe you're just not a numbers person. Maybe you don't really like dealing with your personal finances, and so you've been avoiding your business finances in the same way. But a little bit of tough love here. Those problems are never going to sort themselves out by avoiding them. So today we're going to talk about some of the basic principles that you need to have an understanding of financially in order to be able to grow your business. I've had the pleasure of working with dozens of different business owners, and one thing that I see that comes up over and over again is they don't understand how much money they're actually making. So most people do understand what their revenue is, because that's the sexy number that everybody likes to talk about. But in terms of the actual profit they're making every month, that's something where there tends to be a bit of a gap. One of the reasons that this is problematic is it makes it really difficult for businesses to know how much to pay themselves. And if you're not paying yourself in your business and you're not making any profit, you actually have less of a business and more of just a really time-consuming hobby. To set yourself up for success in this arena, there's 4 important things you need to consider as you're starting out. The first one is to ensure that your personal and business finances are completely separated. This means separate bank accounts, separate PayPal accounts, separate credit cards. You want to make sure that all of your expenses are completely separated out. So if you're buying anything from your business, it is only coming from your business funds. I would also really encourage you that if you're not great at handling your own personal money, or if you really have no desire to learn about bookkeeping, as soon as you can afford it, hire a good bookkeeper that can help you to keep things on track. Second, in order to be profitable, you have to have a really good understanding of what your expenses are and how much it actually costs you to deliver the product or service that you deliver. This really needs to take into account everything that goes into it. So you might have software, you might have contractors that you're paying. Any fees or any charges that go towards whatever it is that you're delivering needs to be taken into account. And an important part of this, which a lot of entrepreneurs skip over, is how much money it would cost them to deliver that particular service. So a lot of us, as we're starting our businesses, we're people who are really good at bootstrapping, and we're probably people who did everything in our businesses to start off with. One of the dangers of that, though, is we start to devalue our time and not recognize how much it's actually worth. So when you're going through and trying to figure out how much it costs you to deliver a particular service, you want to take a look at how much it would cost to hire somebody to replace you for the work that you're doing in delivering that service, and then make sure that you have a really good idea then of how much it truly costs you for that service. A really important element in determining how much it will cost you to deliver is knowing how much of your own time or your team's time goes into that product or service. And a great way to do this is to do time tracking. And you want to do time tracking over several iterations of this exact same project so you can know really quickly at a glance how long it takes to really deliver that particular thing. This benefits your business in a couple of ways. One, it makes sure that you're actually profitable for what it is that you're offering. And two, it actually enables you to give really quick and accurate quotes when people come to you looking to have that same service fulfilled for them. It's also really important to take a look at your financial goals and see if it's actually realistic for you to hit them with the type of service or product that you're currently offering. So let's say, for example, that you offer a service that is $1,000 per month, and your goal is to hit revenue of $10,000 per month. So that seems pretty straightforward. That means that you need 10 clients at $1,000 a month to reach your $10,000 goal. But once you start time tracking, you might start to realize that the amount of time that you're actually investing into each one of those clients per month is a lot more than you thought. So let's say, for example, you realize that with the service that you're providing, it actually takes 40 hours per month to fulfill on your client contract. So all of a sudden you have 40 hours per client, you have 10 clients per month. That's 400 hours per month that you need to be able to provide. Obviously, you're not going to be able to handle those on your own unless you want to work 100-hour weeks, which I certainly hope that you're not. So you have a couple of different options that you can consider. You could, for example, begin to hire some team members that could help you deliver some of those client needs. Another alternative is to look at raising your prices so that for that same amount of work that you're doing, you're actually getting more money per client per month that will help you to reach those revenue goals. Or third, it might be time to take a really close look at what it is that you're actually providing for that service. Is there a way that you could structure your packages differently? Is there a way that you could make your service more efficient so it would take less of your hours? There's a lot of things that you can do in terms of your offer to make sure that you are setting yourself up to actually be able to hit the goals that you want to in terms of revenue every month. I would really encourage you to go and speak to a knowledgeable accountant who can help you to figure out how much of your money you need to be putting aside for taxes every month. You definitely don't want to have a surprise in the spring where you have an enormous tax bill that you weren't expecting. And if you are a freelancer or self-employed, there are some different things that you need to consider and make sure that you're putting enough money aside so those type of surprises don't happen. Once you have a really good handle on your expenses and how much money you should be setting aside for taxes, along with what you're going to be paying yourself monthly, you'll start to have profit that's building up in your business. Rather than just taking that money out and spending it, I would really encourage you to set some of that money aside in a special savings account that is used only for emergency purposes, just like you would in your personal finances, to build up a bit of an emergency fund. 3 to 6 months of expenses is a really great idea to have on hand so that when something unexpected comes up, it won't sink your business. There's lots of different things that can come up unexpectedly, from things like clients not paying their bills, or maybe you have a slow month, or maybe you're unable to work for a particular time period, or you have an unexpected chargeback. And we want to make sure that that doesn't have a significant detrimental impact on your business. And being able to set this up ahead of time and to be able to have that profit put into an emergency fund gives you that buffer that you need so that those surprises become inconveniences and not emergencies. Knowing these numbers informs all of the decisions in your business. Who you can hire, how much you can pay them, if you can give yourself a raise, how much you should be charging your clients. And it's so important to be able to go back to data to help you to make these decisions rather than just by going on gut feeling. I hope that this information has empowered you to take the next step to shore up your business finances. And I would love for you to let me know in the comments below how you feel about numbers.
So understanding your financials is how you get the information that you need in order to make the decisions that you need to make when it comes to how much you need to save, how much you're going to need to set aside for taxes, how much you're actually spending on your expenses, and how much profit you're actually making at the end of the day. Or if you're a nonprofit, how much money that you're going to have to fund your mission. So the reason you want to keep records is you want to have accurate records so that you can control your business, you can prepare your tax returns, you can comply with any financial regulations that you may be required to comply with, and so that you can apply for business loans. Having these solid records, these solid business records, puts you in a good position to be able to talk knowledgeably about the financial health of your business. Next slide, please.
If you own a small business or are thinking about starting one, results from a new survey may be a wake-up call for the entrepreneur in you when it comes to managing and, in some cases, mismanaging finances. The survey by office products retailer Staples reveals that 94% of small business owners are confident about managing their finances, yet only 45% can define basic accounting principles, such as accounts receivable, pretty important, and accounts payable, also up there. And 23% have bounced a check in the past. 29% have postponed paying vendors or suppliers. If any of this resonates with how you're running your small business, there are some key moves you can make to help keep your finances on track. Number one, keep personal and business finances separate. One of the first steps to owning a business should be opening a business bank account separate from your personal bank account. Many banks offer free business checking accounts, so costs shouldn't be an issue. Having a separate business account also makes life easier at tax time, as you'll need to file your business income and expenses separately from personal transactions. Another easy way to distinguish between personal and business expenses.
No. Come on now.
Resonates with how you're running your small business, there are some offer free business checking accounts, so costs shouldn't be an issue. Having a separate business account also makes life easier at tax time, as you'll need to file your business income and expenses separately from personal transactions. Another easy way to distinguish between personal and business expenses is by using a separate business credit card. Plus, it can provide an additional line of credit. Number two, create a budget, a real one. This will enable you to quickly track cash on hand, business expenses, and how much revenue you need to keep your business growing, or at least afloat. By committing these numbers to paper, your chances of succeeding are helped by anticipating future needs, spending, profit, and cash flow is really important. Number three, this tracks back to number two, follow the money. This one seems like a no-brainer, but some small business owners are so focused on day-to-day operations they don't take the time to track invoices and customer payments. Set aside at least 15 minutes each week to keep proper records. That's at a minimum. It doesn't have to be fancy, you should be able to understand it at a glance. Track all payments due and record when each invoice is paid. Take note of how long customers generally take to pay and which customers you've had difficulties collecting payments from in the past. It's a big issue for small businesses. Number four, know when to call in a pro. As tempting as it is to try and save a few bucks by doing your own bookkeeping and taxes, it's almost never more cost efficient in the end. An accountant has better knowledge of how to best manage your finances and minimize taxes. You can also save a few bucks by keeping organized records. The cleaner you keep your books, the fewer billable hours you'll have to pay a professional. For USA Today, I'm Regina Lewis.
So in that short video, she gives you a little more information about the basics of financial literacy for your business. The fact of keeping a separate bank account, much like the first video spoke of, and also talking about accounts payables and accounts receivables. And one thing to know is that you're not alone as a business owner if you're not entirely sure what's going on with your numbers. It's not uncommon for business owners to be working a business and not necessarily know what's in accounts receivables or accounts payables. And just so that you know what those terms mean, accounts payables, those are the people that you're paying, and accounts receivables, that's the money that's coming into your business. So you can see why it's really important to be aware of what those numbers are. How much do people owe you and how much do you owe other people? And that really comes into play on our next slide, where we talk about the difference between cash and accrual basis in accounting. This is the basic accounting methodology that it's important for you to understand how they operate. So when we talk about accrual, that is a very common way for businesses to keep track of the money that's coming and going without it necessarily being tied to the specific period of time. For example, when you pay a bill, if the bill came in a couple of weeks ago and you've paid it today, the way that that gets accounted in the bookkeeping system is through the accrual method, because you're not paying it on the same day it comes in. It's not going directly to cash. Anything that goes through a checking account, generally speaking, is going to be using the accrual method. The cash method it's very, very simple because it records the cash itself as it comes in and out, kind of at the same time, right? You start the month, you get the bill, you pay the bill right then, instead of you get the bill and you pay it in the next month. That would be the accrual system. The benefit of the cash method, it's very simple. It accurately specifies your cash position at that exact point in time. And it's usually used for tax purposes. And that's where you get the concept of, your fiscal year that starts January 1st and ends December 31st. And everything that comes and goes in that period of time is all in the cash basis of money that came in and money went out. But let's say you get a bill on December 25th, or on Christmas Day bill. You get it the day after Christmas, the 26th. And that bill isn't due until January 26th, a month later. So in that situation, because you're not paying that bill on the same day that it comes in, you're paying it a month later, then you've moved into that accrual system of accounting where the bill has come in and it's showing up in your accounts payables, but you haven't spent the money on it yet. That money is still in your bank account until the next month. So you generally use the accrual system when you have bills and payments that aren't happening on the same day as that invoice happens. And that gives you the opportunity to see how the money is flowing on a more fluid timeline than in the cash basis. The benefits of the accrual method is that more accurately illustrates the flow of your income and debts. For example, in that December example, you get a bill that comes in and you haven't paid it. It's not going to show up in the cash basis. There's going to be no record of that until it's actually paid in January. And yet that bill came in during that previous year and could affect your numbers coming in January because you're paying it with the sales from January, even though the bill was incurred in December. Some of the drawbacks when we're looking at cash and accrual is the cash method can kind of distort your profitability because you've paid that bill in January, but that bill was, is something that happened in December. So it kind of gives you this different picture of how the money is moving back and forth in your account. And it's really only appropriate for a cash-based business. The drawback with accrual is it can kind of mislead you with respect to your actual cash position. You will be like, oh, I made all these sales. I made $500 in sales. And yet you're not going to get paid on those sales until the next month. So while they show up as sales in the month when they happen, you haven't actually gotten paid for them until the following month. There are some greater bookkeeping requirements with accrual because it's a little more sophisticated. But generally speaking, when you're running financial statements, you're running reports like a profit and loss or a balance sheet, like we'll talk about shortly here, you're going to run those in the accrual basis because that gives you a sense of what you have and what is due in a more sophisticated way where you can understand it. Whereas with the cash basis, you really only run those reports in the cash basis when it comes to tax time, because you don't want to be taxed on sales that haven't actually come in yet, that haven't actually paid. And we can talk about that in greater length if you have more questions at the end. But that's kind of the basis. Most of the time, you're going to work with your bookkeeper in the accrual system, and you're going to work with the tax man on the cash system. Come on. There we go. So let's say you own a business that sells machinery. You sell $5,000 worth of machinery under the cash method. That amount is not recorded in the books until the customer hands you the money or you receive the check. In the accrual method, that $5,000 is recorded as revenue when the sale is made, even if you receive the money a few days or weeks later. The same thing occurs for expenses. If you get an electric bill for $1,700 under the cash method, the amount is not added to the books until you actually pay the bill. However, in the accrual method, that $1,700 is recorded as an expense the day you get the bill. So while the money may not necessarily match in your account with what's going on in the bookkeeping that way, it is accounting for it so that you know that that $1,700 is spoken for, right? It takes that money out of your expenses already so that you know you can't spend it twice. It helps you to not spend it twice. So it's definitely something that you want to become familiar with. So when we talk about why we need financial statements, it's so that we can describe your business in numbers. You can identify problems early. Let's say you're not getting enough sales in the accrual method. You're not booking enough sales so that the next month when all your bills come due, you have that money after people have paid. It also helps you determine your profitability. You'll be able to see at the bottom of your profit and loss statement how much money is left over, your net profit. You'll also see when we talk about profit and loss statements, we'll talk about common size statements. And within those, you can see what percentage of your sales revenue is actually being used for cost of goods and what percentage is actually your gross profit or your gross margin. And then how your overhead takes out of that so you get down to your net margin. And knowing the percentages within those is very helpful for knowing how your business is doing, the health of your business. Financial statements help you track increases or decreases in the value of your business assets, and that will be on your balance sheet. They help you keep track of your cash and your cash flow, and there's an entire statement called a cash flow statement that goes along with that, and also provides a means of comparison with industry averages, so you can see how your business is doing compared to other businesses that are similar to yours, and it'll help you track changes in your business over time or the trends. So what do the financial statements tell us? The balance sheet is all about a point in time, and it tells us about our assets, both tangible and intangible, and it tells us about the balance of our short-term liabilities and our long-term liabilities and our equity. And the assets, tangible assets, for example, are going to be things like the equipment you own. Let's say you own you're a wind turbine company, and how many turbines do you own, right? Those are your fixed assets, and they're going to depreciate, and you'll see that on your balance sheet because over time, much like a car, they're not going to be worth the same as they were when you bought them. And on the other side of the balance sheet, and again, it's a balance sheet, so the numbers balance, you'll have your debt and your ownership. Your short-term liabilities will be things like your credit cards or payroll taxes. Those are short-term liabilities that you're keeping track of so that you know how much you owe the IRS for your payroll taxes. Your long-term liabilities would be things like a business loan, and the business loan will show up on your balance sheet, and you'll see the number of it going down over time, and the profits that your business make become your owner's equity, and those will pile up and grow your owner's equity over time. On years that you have a loss in your business, your owner's equity on the balance sheet will go lower. So the balance sheet is all about what's happening at this little moment in time, this up to this point. When you're talking about the profit and loss statement, which is also called an income statement, that's talking about a period of time. So that's talking about you can run a profit and loss statement for however much time you want. Let's say you want to know how you did last month. So you run a profit and loss statement from the first of the month till the end of the month, and it'll show you the money that you made, and it'll subtract out the cost of the goods that you needed to make those products. And then it'll take out all of the expenses that you had along the way, your rent, your utilities, etc. And at the end, that'll show you what's left over, your operating profit or your net profit. And that can be for a month, a quarter, a year, 5 years. You can do a comparison with a profit and loss as well, where you do Let's say you run a profit and loss for the quarter, and you could separate out the columns by month. So you can track each month, how are your sales doing from month to month? And how are your cost of goods doing in relation to that month to month? And what's your final profit month to month in that quarter, for example? The cash flow statement it kind of connects the two. It goes between the periods, and it shows the change in your cash position from one balance sheet date to the next. And you'll have your money that comes in and your money that goes out, and whether it's positive or negative at the end of the period that you're running for that cash flow. And it shows things like your operating and your investing and your financing activities within that cash flow statement as well. The profit and loss statement doesn't show you much of that investing or that finance activity. It's going to show you the day-to-day activity of the money coming in from sales and the money going out for bills, but it's not necessarily going to show you those loan payments that you have to make, right? The interest payments on your loans. You're going to get that from your cash flow statement. So we'll dive a little deeper here into the balance sheet equation. It's pretty thick, but you'll have this to look at, and you're welcome to explore the internet to learn more about balance sheets. The balance sheet is something you want to look at on a quarterly basis generally. A balance sheet is something a lender is going to care about. They want to see that you have good net worth from your balance sheet, for example. And so on the one side, you have your assets, and they will equal the total of your liabilities plus your owner's equity. So your assets will be your cash, your temporary investments, accounts receivable. That's the money people owe you. You count that as an asset because you could get that from them. It's money they owe you. It's money you've made. Your inventory is part of your assets, your supplies and buildings, if you own property as part of your business, and to a lesser extent, patents and goodwill. Most small businesses don't necessarily have that listed on the asset part of their balance sheet, but a larger business often does. Your liabilities will again be those things that you owe, the accounts payable, the bills you haven't paid yet. You've gotten the bill, but you haven't written the check. Those are your accounts payable, and those are your liabilities. Your long-term liabilities are going to be financing, the taxes that you owe, like I said before, salaries that you have on your books that are going to be coming due. Those will all show up as your liabilities. And then those are added. And if your liabilities, let's say you have a $50,000 loan and you have $100,000 you've put into the business, that's going to even out to be $100,000 because the loan comes off of the equity. And your owner's equity is going to be the money from profits that you have put into the business over time, the money, the profit your business has made. And your owner's equity will, or sorry, your owner withdrawals will be the money that you've taken back out of the business. And so the equity portion of your balance sheet is how you can see what money you've taken out of the business and what money you've put into the business as well. Your investments into the business will show up in your owner's equity, and you want that number to be as positive as possible. A lot of businesses after COVID, owner's equity on the balance sheet has taken a major hit. When your business posts a loss, that comes straight out of owner's equity. But again, that's not necessarily something you will see on the balance sheet, but the balance sheet feeds into the profit and loss statement. I'm sorry, the profit and loss statement feeds into the balance sheet. And your retained earnings, that's the money you've made over time that builds up in your account, in your balance sheet account. And so here's a basic balance sheet statement. Oh, someone's coming in. All right, we got them. Your basic balance sheet statement, as you can see in this example, your current assets are cash and inventory, which comes up to $40,000. Your fixed assets are going to be your equipment minus the depreciation, like with the car example. As soon as you drive that equipment off the lot, it's worth a little bit less. And that's your net fixed assets in this example of $5,500, which gives you a total assets of $45,500. Now on the liability side, you have your accounts payable, which is $1,000, your taxes payable, which is $2,000, making your total current liabilities $3,000. Your long-term liabilities are $5,000, and that gives you a full $8,000 in liabilities. And when you Combine that with your owner's equity of $37,500, you get that $45,500. And so this has to equal, the total assets have to equal the liabilities and owner's equity. So if your liabilities are more than your equity, they're still going to have an effect on your assets. And until those are in balance, your balance sheet isn't balanced. And the balance sheet is all about being balanced between these two sets of numbers. Now, when we talk about the profit and loss statement, this is about tracking your results of your operating activities of a business on an ongoing basis. Measures your company's sales and expenses during a specified period of time. Your revenue minus your expenses is your net income. In this example, we have a sample profit and loss statement. So your revenue at the top line is at $10,000. Your cost of goods was $5,000. And that gives you a gross profit of $5,000 in this example. From that $5,000 gross profit, you'll take out your overheads. In this case, we have payroll, rent, insurance, marketing, and your accountant for a total of $3,500. When you subtract those expenses from the gross profit, that leaves you with a net operating profit of $1,500. And you've paid some interest, and so that will come off of that number and give you a profit before tax of $1,300. And then you'll pay whatever taxes are due. In this case, they were $300, leaving you a net profit after taxes of $1,000. So sometimes it can be tricky to get your accountant, your bookkeeper to set up your profit and loss statement to show taxes paid in this way. Sometimes they'll be hidden up higher. Oftentimes those taxes will be payroll taxes, and you'll see those on a profit and loss. Generally speaking, a profit and loss will give you the amount due at the end. What you don't see here is those financing activities of if you got an infusion of a loan, a business loan, for example, and paying down the principal on that loan. That's what comes on the cash flow statement. But the profit and loss statement is far and away the most important financial statement for you to be familiar with in your business. You can operate without having a firm understanding of a balance sheet just fine. Take it from me. But you really have to have a firm understanding of the profit and the loss statement, because the profit and loss income statement is essential for knowing how much money is coming and going. The balance sheet is nice to understand because then you can see how your liabilities affect your equity, and you can see how your assets are balanced out with that. But the profit and loss is your day-to-day piece of paper, your day-to-day report that you want to keep an eye on a regular basis. Oh, I did have one thing for you. There is a thing called the common size profit and loss statement, and I have may the thing work for me. I have a short video on that, and that's not it. It's this one. So this is a little bit more about the common size income statement. And this is a really helpful tool to learn to use with your profit and loss statement, because it can really help you see the health of your business, and you can get a feel for the percentages that make your gross margin and your net margin. Generally speaking, the closer to 50% net margin that you can get, such as in our profit and loss example, that was a 50% net margin, because $10,000 minus those $5,000 left $5,000. That's a good number to start with on your profit and loss percentage for your gross margin. It puts you in a nice strong position. All right.
Dial pad has complete.
All right, and of course there's always an ad, because that's just how it goes. There we go.
Each item on the income statement as a percentage of sales or total revenue. This allows you to analyze changes in a company's cost structure over time. For example, we can see that Amazon's G&A expense was consistently around 1.9% of net sales from 2018 to 2021. This means that 1.9 cents of every sales dollar went to G&A expense. Now, the common size income statement also shows you a company's margins. how much of every sales dollar became profit. In 2021, every dollar of net sales for Amazon generated 5.3 cents of operating income. The common size income statement is also helpful in spotting significant fluctuations in a company's income statement items over time. With Amazon, we see that non-operating revenue is typically a very small percentage of Amazon's total net sales. But in 2021, it jumped to 3.1%. This is because Amazon recognized an $11.8 billion gain on its investment in Rivian when the company went public. But a common size income statement is not just used to assess a company's performance over time. It's also used to assess performance between companies. Scaling each line item by total sales is very helpful when comparing companies that report financial statements using different financial currencies, or when comparing companies that are of very different sizes. For example, let's compare Amazon's marketing costs to those of Netflix. Amazon spent a lot more than Netflix on marketing in 2021, $32.5 billion for Amazon compared to just $2.5 billion for Netflix. But Amazon's net sales were 15 times larger than Netflix's revenues in 2021. Amazon is a lot larger company than Netflix, thus we would expect Amazon to spend more on marketing than Netflix does. But when we look at marketing costs as a percentage of sales, Amazon actually spent a lot less than Netflix in 2021. 6.9% for Amazon compared to 8.6% for Netflix.
So you can see in this example where they have 100% of total revenue, and the cost of that revenue is that 58%, which gives them a 41% gross profit. And this is what I'm talking about when you take your expenses and your your expenses and your cost of goods as a percentage of your sales. The sales are 100%, and everything below that is that percentage of that number, and they all add up to become that 100%. In this case, you can see that there's 2.4% of sales was taxes. And the earnings before taxes was 19.7% of sales. So what this does for you is it lets you see, in this case, this gross profit margin is 41%, which is pretty good. Nothing, that's a good number to have. And you want to use these numbers so you can track how your percentages change. For example, you can see how the 15% in marketing has gone down over the years. They've managed to spend less of a percent of their sales in marketing. And so if you think of this as $1, this means that, if cost of revenue, we'll call this cost of goods, which is, more aligned with probably what your business is. For every dollar in sales, they spent 58 cents on their cost of goods, which left them about 42 cents for their other expenses. We'll let him finish talking.
We see the same pattern when it comes to general and administrative expense. Amazon spent a lot more than Netflix in terms of total dollar amount, but it spent less than Netflix as a percentage of sales. Thus, Amazon spends a lot less of every sales dollar on marketing, general, and administrative costs than Netflix does. And yet, Netflix had a lot higher operating margin than Amazon. How was this possible? Amazon has a significant operating expense that Netflix does not have: fulfillment costs. Fulfillment costs were 16% of Amazon's net sales in 2021. So you can see how a common size income statement is a great tool for seeing how a company manages its costs, both over time and in comparison to its peers. But you need to be careful when interpreting a common size income statement. And this is because the line items aren't independent from one another. Here's what I mean by that. A cost might increase on an absolute basis, but decrease as a percentage of sales. For example, Netflix's marketing costs increased by $300 million from 2020 to 2021. Yet Netflix's marketing costs as a percentage of revenue decreased over the same time period. The explanation? While Netflix's marketing costs increased, they increased at a slower rate than Netflix's revenue. Thus, Netflix spent more on marketing, but marketing came down as a percentage of revenue. Alternatively, you could have a situation where a cost remains constant. It's a fixed cost, but the cost comes down as a percentage of sales because the company's sales increased. Remember, a common size income statement does not tell you whether a company's costs went up or down. It tells you the cost as a percentage of sales. Now, if you'd like to access the spreadsheet with the common size income statements that I used to make this video, there's a link in
So I hope you appreciate a little bit of that deeper knowledge there on the common size income statement. It is a really helpful tool, and it's very easy to run in most common bookkeeping systems. You just run, there'll be a tab when you run a report that says, run the report and show the percentage of sales. And right alongside, just as in the example that we have here on the screen, in this column, you would see that percentage, and you would have 100% here where this 10,000 is, and then a 50% here and a 50% here. And then all of these would be their own percentages all the way down the line until you get to this last number, your profit after tax in this example, which would be 10%. So that gives you an opportunity to kind of see how those percentages work. And it's a really good tool for understanding how your numbers are flowing. Moving along to the cash flow statement. This describes sources of cash and spending over a specified time period. It doesn't include non-cash items such as depreciation. Those belong on your balance sheet. Short-term viability of a company and its ability to pay bills is illustrated by the cash flow. And reviewing your cash flow statements at least every quarter is a really good strategy for making sure that you're getting all of the money where it needs to go, and that you understand that you have the money that you need to pay all your bills, as well as to budget some for your profit. So we'll walk through this quick cash flow sample. And basically you start with you have your starting point. You just pick any point in time. In this case, it's before June on this one. And you have your cash on hand, your cash sales, how much the owners put in, any loans you have. And then you have your cash in total. And then you have your inventory, your operating expense, your leasehold improvements, your loan payments, capital purchases, and your owner's draw, and that's your cash out. And at the bottom, you'll have your cash position. That cash position down here is going to jump all the way up to the top of your cash on hand in the following month. And so the next slide will show you what it looks like as it gets filled out. So you've got no cash sales because you just started, you have a loan, you have your owner's contribution. It gives you $25,000 in cash in. We'll take out 5 for inventory, 2 for expenses, 3 for rent. You haven't made a payment on the loan yet. Any capital purchases you probably made with that loan. And then your owner's draw, you didn't get paid this month. And then your cash out was 15, leaving you with 10,000 available. And that starts the next month. And then you have your cash sales. You actually made some sales that month. The owner didn't put anything in this month or the next few months. And so it's going to extrapolate a little faster. And then you'll have your cash in of that 17. You have the 10,000 from the previous month plus the 7,000 that you made in sales. And then you had to buy some more inventory. Your operating expenses were a little bit higher. You didn't have to do any more leasehold improvements because you already built out the space. And now you're making that loan repayment, and you can see how that shows up in your cash flow statement. And you didn't have to make those capital purchases because, like the leasehold improvements, you already made them. But now the owner got paid. And that leaves you at the end of the month with $9,750 that you've taken out, leaving you with $7,250 in your cash position. And as you can see, that pops back up to the top of July. And then you sold $8,000. And so you had cash in of $15,250. And you had to buy a little more inventory this month because you had some higher sales than the month previous. Your operating expenses stabilized and the owner got paid again. And you spent a total of $10,250, leaving you with $5,000 at the end of the month, which came back up to the top in August. And this month you sold $9,000 in sales, giving you $14,000 in cash in between the two. You had to buy a little more inventory because, again, you sold more. Your operating expenses have stayed stable and you still got paid. And then at the end of the month, you spent $10,750, which leaves you $3,250 at the end of the month to start September. And as you can see, the cash position is starting to go down, and that's a little concerning. So let's hope that we made some decent sales this month. And that gives you $11,250 in cash in, and you had to buy some extra inventory because maybe you're planning for a big October. Operating expenses stayed the same, you still got paid, and the cash out was $12,250. And at the end of the month, now we're in the negative. So by doing a cash flow statement, you're able to kind of see like, maybe we need to spend a little less on inventory so that we don't end up negative at the end of the month. Are there ways we can adjust our operating expenses so we don't end up negative at the end of the next 4 months? So this, the cash flow statement gives you opportunity to see the road ahead. And that's the main purpose of these financial statements, is being able to see what's going on, to understand how the money is moving within your business. And cash flow statements and profit and loss statements are very helpful for that. So the cash flow projection is there to show the timing and movement of money in and out of your business, how you'll cover your expenses, repay loans, and pay yourself at a reasonable amount, and create a reasonable profit. It helps you determine the feasibility of your idea and predict your cash flow position, predict your cash position each month, which is essentially projecting your bank balance. And it helps you identify any cash flow gaps so that you can plan ahead. So by having a cash flow projection that goes out a few months, you can see the trouble coming before it gets there. And while they're projections, they're estimates, it's better to have an estimate of knowing you may need more money or need to cut back on your spending ahead of time before you find yourself suddenly coming up a little short. And so my next video talks in a little more detail about how to fill in a cash projections worksheet. And you have them in your materials, and we also put them in the chat. I think they're kind of back in the chat, but you're welcome to find them in your email or find them in the chat kind of towards the beginning and download them so that you have a copy, and save it as a copy and give it a name. You can just do test and experiment around with your cash flow projections. There will be a sample in your materials of a typical small business cash flow report, which we'll look at next after this. We're going to go through this video of watching the numbers get filled in and talking about them a little more. And then you'll have a blank one, which you can experiment with. And if you're looking at doing more than one business, or you have more than one business idea you want to test out, make a bunch of copies, do a bunch of different projections. You can do a high projection if you think your sales are going to just rocket out the door, or you can do a low projection because you're not sure, you want to be kind of on the more conservative side, and you want to make sure that you're not getting ahead of yourself, or you're not sure if your idea is going to catch on right away. You might need more of a runway to ramp it up. So it's always good to have a couple different projections and give them names that are meaningful to yourself so that you can understand what they're doing. All right, and now we're going to go into this other video I have for you. So this is a much longer video. We're not going to watch the whole thing. We're going to watch the different sections where she's talking about important parts of filling out this form. And after we've watched this, we're going to break out into breakout rooms, so you have an opportunity to experiment around with these cash flow projections and get a feel for how they work. And then we can answer some questions afterwards. So we're going to start with her talking about the initial startup expenses at 310 here. All right.
So things that you are needing to open your business. So if you're a startup, these are things that you need to purchase to open your business, and you need funding for, wherever that funding is going to come from. If you are an existing business, these are things that you are going to need to grow your business, maybe purchase something, maybe add an employee. So this workbook is geared towards both startups and businesses that are growing. So you just want to keep that in mind. Now, if you are a startup business, I would suggest you go through this worksheet, go through all the tabs first, and familiarize yourself with the information that you're going to need. So some of the numbers you're going to need, because you might have to do some more research. You may not know the answer to the question. You may not know how much the remodel is going to cost if you're going to be leasing a location. You may need to get some quotes. Again, enter first what you already know, and then continue as you do your research, gathering information, then enter the information as you go. You don't have to complete one tab before you move on to the other.
And that's an important thing to know. You can put information in one tab as you get the information and move around. Now, the tab that you've all been given in your materials, it doesn't have the payroll tab that this one has, and I believe it doesn't have the there's a financing tab that they talk about in the long form of this video. You will be able to, I believe you'll be able to access this video from the slides afterwards. So they may go into more detail than you need, and your sheet doesn't necessarily have that, but that's because this form is when you're actually in the process of getting funded through a lending institution, and they're going to want a little more depth. For your purposes of getting your business started and understanding how these cash flow and profit and loss statements all work together, these projections, the form that you've been given will be a great start. And then as you're going into funding, then you can take it to the next step. She's going to talk next about projected sales and how that works on the form. And that's at 5. There we go.
On to the very next tab, your projected sales forecast. This is honestly just what it sounds like. What do you plan to sell? Okay, now you can navigate this worksheet by typing in whatever date that you would like the workbook to start with. At the very, very top here, cell C7. So if we wanted to start this workbook to start in December, and we wanted to show our sales, say December 2021 through now, that gives you a 12-month forecast all the way across the top. It auto-populates. So you've got December of 2021 all the way through November of 2022. Okay, so this gives you one full year of a sales forecast. Within your column A here, all you have to do is fill in these green columns, but these are going to be all of your additional revenue streams. So if you are selling gloves, for example, how many gloves do you plan to sell? If you are selling services, okay, packages of photography, for example, maybe you sell 2 packages of photography for $139 a package. That's what would go here, to $139. So whatever this looks like, how many you're selling and at what cost you're selling it at, that's all you're going to fill in here. Or however many different revenue streams or however many different ways that your business has to earn money.
So that, again, to reiterate, you're going to put in however many of whatever it is you're selling and what that price is that you're selling it at. If it's for example, if it's a consultation on a rain garden, and let's say that basic consultation for building a rain garden for a client is a $50 per hour consultation, and generally takes an hour. And you plan to do, 6 of those in a year, or I'm sorry, 6 of those in a month. Then you would put 6 where you have the number, and you would have $50 for how much you're charging for that hour of a rain garden consultation. And then that will give you, it'll do the math for you, whatever the package is that you're working on. And now we're going to go into a little bit about cost of goods, because that's the other half of the sales. You want to make sure that you have, that you account for how much it costs you to provide what you're selling.
Okie dokie. So moving forward with your cost of goods forecast, okay? So once we've listed out all of our sales, all of our different revenue streams, how much we're selling at what price we're selling it at, now we want to think about how much it cost, okay, for each unit or each product that you're serving or that you're selling. So for instance, we sold 22 gloves. Well, to sell those 22 gloves, it cost us $330. Okay, what does that total look like? And then everything's going to auto-populate here with the cost of goods. When you're thinking about the cost that it takes to produce, this is when you're thinking about how much does it take to produce 1 unit of what you're doing, okay? So that's what you want to break down here within these sections.
And again, the spreadsheet will automatically fill that in for you. Let's say your cost for that rain garden is for the rain garden consultation. Let's say you're paying yourself $25 an hour for that consultation. It's kind of a low price per consultation, but you would put that $25 in the cost to produce this item. And, you know, you're planning to, you're going the 22 or however many you sold, the 6, that will carry through from the previous sheet. All these sheets feed into each other, which is really nice. It makes it easy. You fill the stuff out on one sheet, it populates into the next sheet for you. And then we're going to talk a little bit about the difference between fixed costs and variable costs, because when you're thinking about break-even numbers in particular, which we'll get to at the end, that's where it really comes into play, knowing the difference between those two. Here we are.
Everybody's favorite form, the projected profit and loss. Okay, how do we know how this business is doing? Where are the expenses and things? This is what the projected profits and loss will show. It will actually show how profitable the business is. It will show how much the business is actually spending as far as what their expenses are every month. So within this form here, all you have to do is think about what you're spending every month. Now, this is not a part of your cost of goods. These are going to be your fixed and a variable expenses that you spend per month as a business owner. So are you spending money per month for things like advertising and marketing? Okay. Do you have a business auto expense? Do you have fleet vehicles? Okay. Do you have to drive to a certain number of jobs that's going to cause a fluctuating fuel cost? What do those costs look like per month? Do you pay for your computer and internet? Now you can definitely go down here and look at all of these great examples. There also might be something that you pay per month that's not on here. Feel free, you can always add the expense, but what you want to do is show where you're actually paying those every month and how much you're paying those. But that essentially all you're going to list on this sheet is just your expenses and how much you're spending per month, either your fixed or your variable rate.
Yeah.
And then the seasonal fluctuations when you're working on a projection are really important to keep in mind, because you're going to find that things aren't always the same every month. It would be nice if they were, but they generally aren't when it comes to your finances.
And then again, think about the fluctuations. I'm going to drive this point home. It's a big red flag for a lender if you just put flat amounts. Now, in expenses, especially operating, those fixed costs that are going to be the same every month, no matter if you sell anything or not, some of them are logically going to be the same every month. So some of these are going to be the same, such as rent. That's just something, it's a contract that you pay every month. So yes, some of them are going to be the same. Advertising and marketing, probably not. If you need to put out a push at the beginning of your business, your advertising and marketing costs are going to be higher at the beginning. Also insurance, some expenses you may pay once or twice a year. Don't break them, don't divide it by 12. So if you pay your, $1,000 for insurance once a year, don't divide it by 12, put it in the actual month that you expect or are going to pay it. Again, this has a big impact on actually your cash flow, which Amber's going to get to next, because that's going to show what month you actually have money and what months you may be running a little thin. We want to be prepared for that, and the lender needs to know that as well.
Right, so that gives you a basic overview of how these numbers between your cost of goods forecast, your projected sales forecast, your startup costs are all going to feed into your projected profit and loss and your projected cash flow. And that seasonality is important. If you're running a food business, for example, once a year, you're going to have a $1,500 payment you have to make to the health department for your inspections, for example. You may have some other licenses, or you're Labor and industry payments will be quarterly, and so those will show up, 4 times a year. You'll have to have the money ready for that. Similarly, depending on how you file your business and occupation taxes, if you do sales taxes, you may be on a quarterly plan and have to come up with that sales tax every quarter. Another area where it's good to have a separate bank account for that. So you can keep that sales tax money aside. And so now this is going to give you an opportunity to dive into those workbooks. This would be a great time for us to break out into some breakout rooms for 5 or 6 minutes, ask each other some questions, look at these forms, put some information in there, and kind of give each other a chance to talk about what is working for you, what isn't working for you, what makes sense to you and what doesn't. Does that sound good?
Jessica, I have a suggestion to do it all in the same room. We've lost some folks on the way. Probably it was a bit too scary to do it on the spot.
Yeah, that's fine.
I put, and yeah, looks like someone is driving, so they're able to use the laptop. Does any of you want to kind of be the lead folks who are in the room? Maybe we can kind of use you as example and just go over that spreadsheet all together. I put both spreadsheets in the chat. One of them is the empty one. And the second one is an example.
Yeah. If you like, I can also pull one up.
Yeah, maybe that would be helpful. Kind of to take everyone through the same process, but now kind of more step by step. And it might be a bit intimidating probably for folks who do it for the first time, and maybe some don't even know, like, oh, like how much it's gonna cost, what are my numbers. So it will take some time to kind of think about it. Right.
Well, so up on the screen we have we're looking at a projected profit and loss, and this is a general small business example where we have, our different products and services. I'll show you their projected sales forecast in this, item number 1, they think they'll sell about 20, they're going to cost $25, and that'll bring them in about $500. And so then they have that kind of broken out across all of the months. They're going to sell more in February than they did in March. And then you can see how they have, 7 different items on their monthly amounts that they're hoping to sell from those. And then you can see the cost of goods, and you want to make sure that, item product service number 1 on the cost of goods matches your item product service number 1 on the projected sales. So just keep those things the same for each, so that, so they track. So you're having the actual cost of goods for all the different things you're thinking of offering. And in this case, you can see the monthly totals of the cost of goods that they're anticipating and how they flow over time. And then the projected profit and loss shows you all of the items together, how much you're hoping to make, your total sales across the board, and then all of your cost of goods that you're hoping to spend to make those things, and your gross profit across the board all the way across. And so this shows you, how much you're making each month from those items. And then you get down into here, and these are your expenses, your fixed and variable expenses. You have your gross wages. It looks like they were probably, the owner was working for free for a few months in this example. And then they were able to hire someone to help them. And then they have those payroll expenses that go alongside of that. And then there are various shop expenses, repairs and maintenance. And you can see the repairs and maintenance, something needs a repair here, something needs a repair there. So they're putting those in about quarterly. Your accounting and legal costs are also coming in about quarterly, and that gives you that seasonality. This looks like a end of the year tax time here where you may have to spend a little more. Looks like they didn't have to pay rent for a while. Maybe they prepaid, or maybe it was a sweet deal. And then their rent payment goes into there. And you can see how all of the expenses add up into your total expenses for each month. But once you've hired someone in this example, you can see how the expenses go up a little higher. And then the net profit is going to be this number minus this number gives you this number. And you can see how that net profit goes all the way across. Now, the magic happens when you get to the projected cash flow, because in this example, you have all of the information from your total cash in, and this is those end of the month money that's left over, like we did in the previous cash flow example, the statement. And you can see how all of those numbers have been brought up to the top here, and your total cash available before the cash goes out. And then down here, you have those monthly operating expenses that we saw back in that projected profit and loss, your cost of goods that we got from our cost of goods forecast. The owner draw is where you put this in here, because in the cash flow statement is where you can figure out how much you can pay yourself. And then you can see your total cash paid out for each of the months and what your cash position is after that. And then you have your loan payments and your total ending cash at the end of the month. And in this example, it shows you your loan outstanding. You can watch the principal go down over time. And as you can see, you don't want the ending cash at month end to be zero ever. But for example, so this 8420 should come right back up here to the beginning of the month. And the same thing happens. You go all the way down to the bottom of April, and you have 7,741 left over, and you bring that up to the top and put it at the beginning of May. And so that's your projected cash flow, and that's how it flows through the account. Let's see. Oh yeah, I see some good questions in the chat. Yeah, it is hard to make precise projections. So that's why I encourage you to make a high one and a low one, and hopefully come out somewhere in between, right? If you make a low one, then you'll know, oh, these are the danger numbers. We need to be above these numbers. If you make a high one, it's nice to be able to go, ooh, if we're making these numbers, we're golden, for example. And so that's the basics of doing those financial projections, so that you can understand how those numbers are moving. And we have just a couple slides left before we end here. And we're going to talk about budgeting. These cash flow projections, these financial statements, they give you the information you need to be able to make a reasonable budget, to make a realistic budget as close as possible. Again, they're projections. They're not going to be super precise. Precision is like hindsight 2020 on these. But having that projection at least lets you know if you're going to be running into trouble. And you can base your numbers, especially when it comes to budgeting, on your historical norms. For example, if you've been in business for a little while, and after you've been in business for 3 to 6 months, you'll kind of get a feel for what your norms are currently, and you'll get a feel for how often you acquire new customers and how that fits into your cash flow. And again, having a high and a low projection gives you some flexibility as far as knowing where you're going to be. You're going to want to run your reports generally monthly, so you can adjust your budget projections and try to be as realistic as possible with revenues and expenses. And you want to work towards budgeting enough cash to carry the business until it generates a positive cash flow and be able to handle unanticipated expenses. And so this short video is going to talk in a little more detail about that financial management piece as well.
Just like you need air to breathe, your company needs cash flow to stay in business. Many small business owners avoid managing the money part of their business. This could be because it may seem difficult to understand. Financial statements look intimidating. It's more fun to work on marketing. They have hired a bookkeeper, or maybe they are too busy. It's important to pause and look at your numbers often. Your financials tell you about the health of your company. If you are feeling intimidated by financials, this video will help you master 3 key concepts. Our first concept is cash flow. It is important to know when the money comes in and how it is being spent. You want to ensure your bill collection and payments are on time. Doing this will help you stay on track and plan for emergencies. If you run a seasonal business like a landscaping company, your cash inflow for the entire year may happen in just a few short months. You will need to plan for costs, such as rent and utilities, when business slows down. The second concept is startup costs. To calculate your startup costs, list all expenses you can think of that might be required for starting your business. There is no magic formula beyond that. When you're in the planning phase, you may find some costs that aren't yet covered by sales. Knowing these costs allow you to know how much cash you should have in the bank before starting your business. Here are a few examples of startup costs. one-time expenses, such as permits, licenses, registration fees, logo design, business cards, website, down payment on rental property, and leasehold improvements. Ongoing expenses, such as rent, payroll, taxes, accounting services, insurance, utilities. Investment in assets, such as equipment, inventory, furniture, and vehicles. Finding these costs will allow you to know how much money you need to personally invest and/or finance to get started. Just add them all up and you have your number. See? That was easy. Our final concept is the break-even point. So you want to start recovering your costs, paying your expenses, and generating a profit from your business? You will need to know how many products and services you must sell and at what price you need to sell them at. To do this, start by understanding your company's break-even point. The break-even point is the point at which your sales will exactly cover your expenses. Determining the break-even point allows you to know the level of sales needed to cover all costs and start earning a profit. To calculate this number, you need to know three things. Fixed costs are costs that your business pays whether you have sales or not. These items include rent, taxes, salaries, and any other monthly expenses that do not change. Whether you sell one product or 20, you still need to pay these expenses. Variable costs are costs that change based on your number of sales. For example, raw materials, factory labor, and sale commissions. Finally, you'll need to determine your selling price for your product or service. Remember, whether you're just starting in business or creating a new product or service line for an existing business, you can adjust this selling price up or down as you start to calculate. Here's an example. Quality Totes Limited is a new company wishing to produce designer handbags. The company has calculated that it has fixed costs that consist of its utilities, owner salary, rent, and property taxes. Those equal $80,000 per year. Their variable costs are the raw materials, leather, fabric, clasps, one part-time contract seamstress, and one family member who has offered to work for sales commission. Based on this information, Quality Totes Limited estimate their variable costs will be $18 per bag sold. The bags are priced at $68 each. At this level of sales, they must sell 1,600 designer handbags per year to cover their total expenses. At this selling price and with these expenses, Quality Totes Limited will not make any profit unless they sell more than 1,600 handbags. They will only break even and cover expenses. Try this formula for your own business. See how cutting your costs or adjusting your price impacts how many products or services you need to sell to break even. Want to learn more about how cutting costs or adapting your price changes your break-even point? Download the Break-Even Analysis Worksheet in the Business Link online toolkit. Now, take a long, deep breath. You're well on your way to understanding how to manage your business's money. Learn all you can about the other formulas you can apply to your business by downloading all the financial resources from Business Link.
Right, so break-even cost is definitely another important part of your financial planning for your business and your financial management. And those break-even costs are generated from your profit and loss statement. You get the idea of what your fixed and variable costs are by being aware of what's on your balance sheet, on your profit and loss statement, because that way you can see, you have your fixed costs on your profit and loss. You can see how your cost of goods may change over month to month, and then you can figure out how many sales do you need in order to hit that break-even point. And there's a number of I think we already saw that one. There's a number of calculators that you can find online, and I think I included some on the last couple slides so that you have that information and you can plug your numbers into there and see how it works. So it's the sales level that's the dividing time between operating at a loss and operating at a profit. So this is your basic formula with your fixed costs being the expenses that stay the same no matter how much you sell, and your variable costs are the expenses that fluctuate up and down with sales, such as your raw materials or the labor involved in manufacturing an item. And lastly, I was going to give you guys a short quiz, but I don't know if you really feel like it. I'll ask a question, and if you want to raise your hand and provide an answer, I think Xenia can can call on you. The first question is, can anyone name the three financial statements, the three basic financial statements we talked about today?
I have the spreadsheet right ahead of me, so I can just read from it. But it was a lot of information for people who don't have financial background. Greg says balance sheet, cash flow statement, Hans said profit and loss.
Yes, yes, fantastic.
Yeah.
Good job, good job. Why is record keeping important for your business? That's another question for you.
You can put your answers in the chat.
Yeah, I think that's a good way to do it.
So why it's important to keep record.
Yeah, because not all businesses keep records. Yeah, do not be surprised. That's an important thing, is
Would it be also to like keep your business healthy and so you can show investors?
Yes. Yeah, and if you work with a business consultant, such as our one-on-one business coaches at Business Impact Northwest, you can share your financial statements with them and they can help you spot problems that might be coming down the road or help you solve problems that you're already involved in. Yeah, and you get a view of what's coming ahead. Exactly. How often should you review your profit and loss statement or your cash flow projections? Maybe just at tax time? I've been guilty of doing that. Full disclosure.
I think you mentioned quarterly.
Quarterly is great. Monthly is better. It's interesting. I might not look at my profit and loss, I might not look at my balance sheet except for around tax time, but I'm looking at my cash flow every week. And I'll generally review the profit and loss once a month to once a quarter. Yeah, a formal quarterly meeting is a great time to look over those reports. And weekly, again, depends on where you're at in your business, for sure. For sure. I think you guys got this. You guys got this. That's awesome. And who wants to say what is the break-even point? Yeah, when your sales and profits equal your expenses. So you've made enough money, you've sold enough stuff to cover the expenses. There's not necessarily any profit left though, unless you've budgeted profit into your break-even point, which is a good idea. Budgeting profit in anywhere you can is often a very, very good idea. And yeah, so once you can get past that break-even point, that's where things really start to happen. And you need to know where that number is. For example, in my business, I know that if we do 4 brews a week, that's going to just cover the bills. When we get to that 5th brew, that's money. And even though the cost of goods and the labor is still coming out, so it's not like we're getting all the money that from the sales generated by that last brew, we are still only getting the margin, the profit margin on that, because we still have to pay the cost of goods and the labor, but we've taken care of the overhead out of that. So now there's no overhead in that equation for that last brew. Or we do 6 brews a week, even better, then I can, pay down some other debts, right? You guys got this. You guys have got this. Fantastic. So, take charge of your financial literacy, know your numbers in your business, because that is empowering, and having a handle on how your numbers are moving and where they're going is going to benefit you in the long term. And it's worth checking it out. But yeah, your first month's predictions can be pretty much a blind guess. It's true until you've built up some some a repertoire, until you've built up a customer base. Generally speaking, those first months, you probably want to lowball it. You want to be like, maybe we'll sell 3, maybe we'll sell 10, maybe the next month we'll sell 20. Give yourself that ramp up time. It would be unusual to open your doors and sell, your final months, or your, a year's down the road's months worth of sales in that first day. It can take a minute to ramp up. How can we use smart financial reporting to compensate for the ugly percentage that a startup represents for a nonprofit? The ugly percent. Oh, yeah.
If I can go back to that. So this was my question right from the very first part. We're looking at adding a nonprofit business component to an existing nonprofit with 501c3 status. Of course, when donors are looking at us to see if we're a good nonprofit, they're hoping to see that we spend a very low percentage on overhead, including staff and rent for the building and so on. When we make this first step into paying the makers first for these products before we make a sale, and it might be a month, right, before we make a sale, but we've had to pay people or basically invest funds into this nonprofit business. So things are going to look pretty gross at the beginning, right? And we face this risk of having a high percentage, an unacceptably high percentage from a donor or investor standpoint that's spent on our overhead rather than on our charitable services. So things will improve with time, but how can we report this in such a way that it's crystal clear what we're doing and why we're spending money in this way? And do you have any suggestions for how to combine this financial reporting with other communication or messaging or something to help people understand why our overhead just tanked, if that makes sense? Thanks.
Well, and I think that the financial projection, a cash flow projection, or a projected profit and loss will help explain that story. And you can also amend that or add to that with your anticipated fundraising earnings, on a quarterly basis, for example. So while the numbers may look bad in the initial quarter, perhaps you have a big fundraising event in that first quarter that brings you closer to making that ugly percentage look nicer, for example.
Actually, if I can comment on that, would not improve our percentage at all, because we would have more money coming in and less going out on charitable services.
Well, but don't you, right? But aren't you supposed to have those donations come in to spend on those charitable services?
Yes, but the donations that come in are to be spent on charitable services. They're not to be spent on our delivery of those services.
Right. But those charitable services, once you get the donations will then be above your overheads. Like your overheads are always going to be this number. They're always going to be this little thing at the bottom that's always annoying you, right? But as you get those donations, you'll have to show that that's going to the charitable services. And that should make the ratio between the overhead and the charitable services balance out in favor of the charitable services, because you can't provide those charitable services without the donations to provide them. And you're going to have those overhead costs no matter what. And so the more you can show when those donations come in to fund the charitable services, that will show how you're spending those donations on those charitable services. And for example, a common size income statement will show that percentage of overhead then being smaller than the percentage that's being used for charitable services. Does that kind of make sense? Does that seem like that would work?
Yeah, I don't think we're on the same page in regard to what the concern is. Our concern is that this outflow that is not spent on charitable services, but is rather spent on investment in this startup, where eventually there will be sales, and then profit from those sales will come back and fund more charitable services. But in those first 3 months or so, it's not, it is just an increase in non-charitable spending.
Sure.
But I take your point about the projections and trying to show this over the long term, making sure that investors and donors can see where we're headed.
Yeah, I think your best bet is probably going to be going for as far out into the future of a projection as you can make. You know, maybe a year. So maybe the first quarter doesn't look great, but the last quarter does. And then that second year projection can look even better. Because once it ramps up, that should show those numbers improving if you've set the model up the way it should work. Does that make sense?
Yeah, it looks like communication will be key.
Yeah, yeah. And a narrative, probably writing a narrative to accompany it will help a lot. And that's where something like a business plan, nonprofit business plan would come into play. I'm definitely weak on the nonprofit side. I've been in the profit sector for 30 years and I haven't done a lot of work in nonprofits. But I do have a feel for showing that overhead is less than what you're spending on other things, at least. And then on our last couple slides here, I do have some additional resources for you, bookkeeping and CPA search tools. So it's the Washington State Certified Public Accountants Association, and you can search for different types of public accountants that handle nonprofits, et cetera. That's a great place to go to find a provider for your needs. And you can usually get a list of a bunch of different ones to check out and interview them, much as you would interview an employee. You want to interview your CPA, make sure you're on the same terms. There's a margin and markup calculator for those of you who are working with more of like a product-based business. But it can also be helpful for your service businesses as well, because you're going to need to put a markup on your service above the cost that it takes you to deliver that service. And a break-even point calculator straight from the SBA. And the SBA.gov website also has a lot of really great resources to explore. And then lastly, if you need additional assistance, feel free to check out our website. We have a number of different events, such as Grow with a Pro. We have a business expert series where we have different people from various industries and professions come in and answer questions. And then we have our whole calendar of on-demand classes. You're welcome to sign up for those and explore our Loan Readiness Center. All of our forms are available on the website as well if you want other copies of financial projections and things like that. There's a lot of great stuff on there. I really appreciate you all coming to today's workshop. Sorry about the technical difficulties at the beginning. I'm glad I stopped screen share and started over because that was the only way it was going to work clearly. So thank you for bearing with me. And I'm happy to answer any other questions that you might like to ask. I have a little more time and I'll go ahead and stop sharing. I'll get the slide deck afterwards. You're welcome.
Thank you so much for joining, everyone. The recording will be available just in a few hours, and I'll stop recording.